Hey everybody, Economic Ninja. Ooh, wrong relation. There's the camera. Hey everyone, Economic Ninja here. I hope you're doing well. I'm gonna be just enjoying this wonderful night. This will probably, I don't know if it's coming out tonight or if it's going out in the morning. But I wanna talk about the markets. We've obviously been seeing a good sell-off in the markets between the S&P, Russell, Dow Jones, NASDAQ. Everything's been selling off, right? Everyone's talking about it's bear market time, all that crazy stuff. Got a lot going on in the world. Inflation is really hitting a lot of companies' bottom lines. The fuel price is just really hurting people. And I want to talk about something that I think may happen, all right? So do me a favor and just sort of humor me for this one. I just want to be able to sit back and talk. And if you do by any chance see an elk, sorry if the camera's moving around, I'm on a flimsy table. If you see an elk cruising by, there was one here just a couple hours ago cruising around. So we'll see if we see an elk. The Federal Reserve has started to raise interest rates, and very slowly, might I add. I do not, in my opinion, non-professional opinion, I'm not a financial advisor, not a stock guy. I like stocks, but I don't get paid to do it, right? So don't take any of this as investment advice. But I want to go back in history. They're not raising rates aggressively enough. They're jawboning. I believe that this is done on purpose to sort of put us into a position where we're really hurting and really needing that new digital dollar. Now, they just started with their first 25 basis point hike. And now all of a sudden we see this downturn in the stock market, right? Analysts are freaking out. We've seen the wealthy move out of the stock market. And I believe that eventually, if this continues, the Federal Reserve will be put into a spot where they have to stop raising rates. Now, the last time this happened was in 2018, after they had risen the Fed funds rate approximately 2%, maybe 1 3/4 if memory serves me right. And by around 2018, I've said this many times before, the Dow Jones started to crater, other markets started to crater. And by the time they hit around down negative 19%, 20%, the Federal Reserve did an about face. Now, the thing is back then, the Fed funds rate was sitting around 2.25%, right? So they had a lot of bullets in their magazine that they could fire off each time, like lower the rates now, lower the rates again, lower the rates, to try and get the economy back on track. And it wasn't until 2020 when all this shutdown stuff happened that the federal funds rate just really collapsed to zero, right? And again, that's the first time that has ever happened. We've never been at zero. We've been near zero, but we've never been at zero. And so now they're raising it. The problem is now this correction is happening when the Fed funds rate is at 25 basis points or 1/4%, and not when it's at like 2%, 3%, okay? That means there's only one bullet to fire. The problem is with that is that if they fire that one bullet, the only other thing they can do is really print money and give it to people, whether it be universal basic income or for, certain segments of the population. But we all know what that would lead to, and that would lead to hyperinflation, all right? The second money gets sent out to Main Street and put in the hands of people that, let's say, probably aren't the best with money, we know that's going to start with transitory hyperinflation because they're going to buy things and there'll be more dollars chasing fewer goods. So it'll start transitory hyperinflation. Then inflation will all start to rise. Then we'll just have massive hyperinflation. And quite frankly, do I think that's in the realm of possibility? I do. I really do, because that would be a great sort of adjunct or entrance into a digital currency. That's a scary world to be in. And so I want people to be ready for that scenario if it happens. If the Fed does not come out in the May meeting and raise rates, then we've got issues, because they know that raising any more is going to tank the market. If the market still is tanking, I'd be shocked, because I'm also going to give you another scenario that I believe is very probable. Well, wait, let me stop here. If that happens and they stop raising rates, the markets are going to rally. You're going to have all kinds of markets rallying. You'll have precious metals rallying, stocks will rally, cryptocurrencies will rally, more than likely, because throughout time, whenever the Federal Reserve comes in and says, okay, we're going to stop the bleeding, we're going to stop raising rates, the markets rally. Ironically, markets rally in the beginning of a extended period of dovish Federal Reserve policy, when they're lowering rates or keeping them low. After a while, what happens is the markets start to freak out, and they said, hey, our currency's not doing well with this low rate. Can we get some higher interest rates? And then when they start to raise rates, the markets go up until they start figuring out, oh crap, everything's costing us more money. and then they tank. It's literally like a temper tantrum, right? They call it taper tantrum for a reason. So if that happens and the market starts to take off, I believe it's going to be short-lived. I don't think will last more than 6 months until the street finally figures it out, like, oh, whoa, wait a minute now. The only reason we're rallying is because we are devaluing our currency even more. We're bringing those interest rates back down. Our economy cannot withstand even a quarter of a point or a half of interest rate increase. Then we are really screwed. And then we're going to see the big one, the big crash, the deflationary spiral, when people panic and start to sell off everything, and then buying real assets because they don't know which way it's going to go. Now, here's the other scenario, is that they keep going full force and they keep raising these rates, similar to what Volcker did, but they won't be as hawkish. They won't have the guts to do it like he did, right? I mean, shoot, they're talking about 50 basis points when, yeah, they can do it, but that's still nowhere near enough. You'd have to be running these things up 1% a month just to see if you could tame inflation. They don't want that to happen because they know the market's going to crash. But let's say that keeps happening. Well, what you're going to start to see is companies, small and medium size, and even large companies will actually start to see a downturn because everything's going to cost them more. The cost of borrowing anything is going to cost more. And then eventually it's going to hit Main Street because it's going to end up you're going to see your auto loans cost more. You're going to see student debt cost more. Credit card debt will go up. All of these things will follow, but they lag. They lag behind the federal funds rate. You know, they all sort of come up together. That's going to be an interesting, very, very interesting thing. Now, ironically, in both of these scenarios, I do not see mortgage rates really going down from here. And the reason why is because, you know, even though today we had a little bit of a reprieve because people were racing into the dollar, so the bonds, the 10-year bond came down, but it came down just a smidge, tiny bit. I think that most investors know either way we're screwed. Honestly, they know, why would I lock my money up for 10 years when I think that interest rates are going to go much higher? They're going to have to. Even if the Federal Reserve doesn't want to raise them, we're going to, because people aren't wanting to store money for 10 years in a clip. So anyone looking to produce, you know, needs to make debt, to borrow money, is going to have to pay a higher and higher interest rate because investors just simply do not want these low rates, right? So either scenario, I don't see personally mortgage rates going down. Well, then the only question is, what's going to happen with real estate? Well, quite frankly, I don't think it's good. I think it's great for those of us that are holding and waiting to rock and roll, because over time, the buyers are going to leave the market, and they already are. We already have the proof of that. Buyers are going to be leaving pretty fast because I think you're going to see they're not getting raises at work. Their cost of living is not going down. So they are not going to be able to afford these homes. And the truth is, BlackRock's not buying all the homes. I hate to burst somebody's bubble. Somehow everyone's got in their mind that BlackRock just can do anything they want, and they can't. Blackstone, we saw, just lost that big Manhattan building, one of their big, huge buildings downtown Manhattan, because they had two of their largest tenants leave. And they literally took a 50% haircut and gave it back to the bank. And I want people to realize that too. Blackstone gave back a property to the bank. They don't just own everything. They're leveraged too, very similar to Lehman Brothers. But I think I'd be surprised if they were smaller than Lehman Brothers at this point. So I wanted to share that with you and just talk to you guys in this sort of format that these are the things that are going on in my mind, all right? There's no right way. There's no one way. I mean, true, history tells us how something ended up happening, but I really do believe that this could go either direction. So I want people to be ready for either direction. And the one thing that you can do to be ready for that is just have patience. That's really the key, having patience, because when you don't, you make bad decisions. So it looks like I got a helicopter inbound, so it's going to get a little loud over here. So I'm going to let you guys go. I hope you guys have a great night with that, or morning. I don't know when this is going out. With that being said, the Economic Ninja is out.